This morning didn't feel like a normal market open. Screens lit up fast, numbers jumped before most people even finished their coffee, and suddenly the word panic started spreading across precious metal circles, not because silver was crashing, but because it was exploding upward too quickly. Silver surging more than 3% in a single session, pushing above $80, while gold sits comfortably above $4,500, is not the kind of move that signals calm confidence. It signals stress, it signals urgency, and most importantly, it signals confusion. Because when prices rise this fast, investors don T ask whether something is wrong with silver. They start asking whether something is wrong with everything else: stocks, bonds, currencies, geopolitical stability. That's when panic actually begins. Right now, headlines are telling you silver is strong, gold is strong, palladium is strong, and yet warnings are being issued at the same time. That contradiction is exactly where people make their biggest mistakes. Many are staring at 5-minute charts, celebrating green candles, assuming this is just another leg higher. Others are frozen, afraid that buying now means stepping into a trap. The truth is, neither reaction is useful unless you understand what this move actually represents. Precious metals don't all surge together in a vacuum. They move like this when confidence in paper systems starts to wobble and capital looks for safety fast. Today's panic is not about prices being too low or too high. It's about speed, leverage, and positioning. In this video, we're going to slow the moment down, strip away the noise, and explain why the silver warning was issued, what professionals are really watching beneath these spot prices, and why reacting emotionally right now, whether by chasing or fleeing, can cost you far more than sitting still and thinking clearly. Why this morning's move immediately triggered warnings instead of celebration. On the surface, silver pushing above $80 looks bullish, even historic, but professionals don't judge markets by direction alone. They judge them by behavior. Silver didn't grind higher on steady demand. It jumped sharply alongside gold, while platinum lagged and palladium moved independently. That divergence matters. When all precious metals rise together in a controlled way, it signals balanced demand. When one metal spikes aggressively while others hesitate, it often points to positioning stress, short covering, or sudden liquidity imbalances. This is exactly what we're seeing now. Silver's move was fast enough to force traders out of short positions, which creates buying pressure that has nothing to do with long-term fundamentals. That kind of buying is temporary, and once it exhausts itself, price can stall or reverse quickly. At the same time, gold sitting calmly above $4,500 tells us something important. This is not a speculative frenzy alone. Gold doesn't move like silver unless there's a deeper macro concern. Rising geopolitical risk, currency weakness, and growing distrust in debt markets are all pushing capital toward hard assets. The warning then is not that silver is bad or about to collapse instantly. It asks that silver is moving too fast for its own structure. When volatility expands this quickly, spreads widen, premiums change, and liquidity disappears right when retail investors rush in, that's when mistakes happen. Part 1 sets the foundation. Today's panic isn't fear of falling prices, it's fear of instability. And instability is where unprepared investors lose money, even in markets that are technically going up. The role of paper markets and why they are the main source of today's panic. Most people think the silver price they see on the screen represents real metal changing hands. It doesn't. That price is discovered in futures and derivative markets where contracts are traded, closed, and rolled without a single ounce ever moving. When silver jumps nearly 4% in a single session, it forces these paper players to react immediately. Margin requirements rise. Risk desks tighten limits and weak hands are pushed out. This is where warnings begin to circulate quietly among professionals. They know that sharp upside volatility can be just as dangerous as a crash because it creates forced behavior. Traders who are short are forced to buy, while leveraged longs suddenly face higher margin calls if price snaps back. That tug of war creates erratic moves that have nothing to do with physical supply. Meanwhile, bullion dealers and wholesalers watch a very different signal: availability. When price moves this fast, mints slow production, distributors hesitate to quote firm prices, and premiums start to shift hour by hour. That's why you often see headlines about silver panic, even while price is rising. It's not panic selling, it's panic hedging. Institutions are scrambling to protect positions in a market where liquidity can vanish without warning. This disconnect between paper silver and physical silver is the core issue most investors miss. You can buy a futures contract in seconds, but you cannot instantly source large amounts of real metal. As volatility rises, that gap becomes dangerous. Part 2 makes it clear. The warning isn't about silver losing value overnight. It's about the market structure, straining under speed and leverage, setting the stage for sudden reversals that catch emotional buyers completely off guard. The focus to physical silver and why bullion dealers are sounding alarms even as prices remain elevated. When spot silver pushes above $80, the public assumes dealers are celebrating. But behind the counter, the mood is very different. Rapid price spikes create risk for anyone holding inventory. Dealers must constantly hedge their stock in the paper market. And when prices swing violently, that hedge becomes unstable. Many wholesalers respond by pulling products, widening premiums, or limiting order sizes altogether. This is where the real warning comes from. It's not that silver demand is disappearing, it's that supply becomes harder to manage. Fabricators slow down because they don't know what replacement cost will be tomorrow. Refineries hesitate to lock in prices. As a result, physical silver doesn't flow smoothly even when demand is strong. For buyers, this creates a dangerous illusion. They see rising prices and assume availability is guaranteed, but in reality, selection shrinks and delivery times stretch. Dealers saying, "I am getting lower and lower on silver," aren't predicting a price crash. They're protecting themselves from volatility risk. They would rather hold less metal than be forced to sell inventory into a sudden paper market flush. This is also when premiums quietly return. Spot may dip or spike, but the real cost of acquiring physical silver rises because nobody wants to commit metal at uncertain prices. Part 3 highlights a key truth. The physical market does not move in sync with charts. It reacts to risk, logistics, and replacement cost. When warnings start coming from dealers instead of analysts, it signals stress beneath the surface that price alone cannot show the psychology of panic and why silver warnings often appear at the most confusing moments for investors. When prices are high and headlines are loud, fear doesn't disappear. It changes direction. Instead of fearing losses, people begin fearing being left behind. This is when warning signals matter most. A silver warning doesn't always mean an immediate crash. It often means risk is becoming asymmetric. Upside may still exist, but downside moves become faster and more violent. At elevated price levels, leverage builds quietly in futures markets, ETFs, and short-term speculation. When even a small catalyst hits, strong dollar moves, margin hikes, or forced selling, the exit doors become crowded instantly. That's how $3-5 drops happen in hours, not weeks. This is why seasoned participants stop talking about price targets and start talking about position sizing and patience. Panic mornings usually follow emotional buying days. Investors who chased strength suddenly see red and rush to sell, locking in losses that didn't exist days earlier. Meanwhile, long-term holders who understand cycles stay calm because volatility is the price of admission in commodities. This part reinforces a critical lesson. Silver doesn't move in straight lines, and warnings are not predictions. They are signals to slow down, reassess exposure, and separate long-term conviction from short-term noise. Panic belongs to those who entered without a plan. Those who prepared for volatility don't panic, they wait. Brings everything together by focusing on what smart positioning looks like in moments like this. When silver issues warnings and panic enters the conversation, the goal is not to predict the next dollar move, but to survive the volatility without being forced out of a good position. This is where strategy separates professionals from emotional traders. Smart money does not chase green candles and does not dump on red ones. Instead, it scales in slowly, keeps cash available, and avoids leverage that can trigger margin calls during sudden drops. Physical buyers pay close attention to premiums because when fear rises, paper prices can fall while physical supply tightens at the same time. That divergence is often the real signal, not the spot price flashing on a screen. For traders, risk management becomes everything. Smaller position sizes, wider stops, and acceptance that missing a move is better than blowing up an account. For long-term holders, the focus stays on fundamentals, industrial demand, monetary stress, and currency debasement rather than day-to-day noise. Silver has always been volatile at turning points, and history shows that the most confusing periods often come before major trend decisions. Part 5 emphasizes discipline, patience, and clarity. Panic rewards speed but punishes emotion. Those who understand the game don't react to warnings with fear. They use them as a reminder to tighten strategy, protect capital, and let the market reveal its next move instead of trying to force an answer. As we wrap this up, remember this. Panic headlines are designed to trigger emotion, not clarity. Silver did not become broken overnight, and it did not suddenly turn risk-free just because prices are high. What we're seeing right now is a market under stress, where volatility is exposing the difference between paper promises and real metal, between short-term speculation and long-term positioning. Warnings like these are not a signal to blindly buy or sell. They are a signal to slow down, zoom out, and think strategically. The investors who survive and thrive in markets like this are the ones who respect risk, avoid leverage they can't control, and stay focused on why they own silver in the first place. Whether this move leads to a deeper pullback or another explosive leg higher, one thing is certain: uncertainty is not going away. And in times of uncertainty, discipline is your greatest asset. Stay patient, stay informed, and don't let fear make decisions for you. If you found this breakdown useful, make sure you're subscribed, because the next moves in silver won't be quiet, and you'll want to understand them before the headlines tell you what to think.
Hello friend, welcome to my YouTube channel. I hope all if you are doing great and having an amazing day. My name is Noor Baqi and I am really excited to start this new journey with all if you. You know, this channel is not just about videos, it is about story and ideas and inspiration. I created this channel to sharing something positive every signal week. Sometimes we all need little motivation, and sometimes we just need a good story to smile again. Decide exactly what this channel is all about. You find understanding stories, real life experience, and powerful lessons that again change the way you think. I be uploading new videos regularly, so if you don't want to miss any of them, make sure to subscribe to my YouTube channel and press this bell icon so you get notification whenever you post something new. Your support means everything to me, and to great we can build a community full of fraternity, learning, and good vibes. So sit back, relax, and let us begin this amazing journey together. Thank you so much for watching and welcome once again.